The stock market is an unpredictable, dynamic place, but with the right mindset and strategies, you can come out on top even during a crash. In this video, we'll be exploring the wisdom of Warren Buffett and his approach to investing during market crises. From understanding the long-term potential of a company to knowing when to buy and hold, we'll give you the knowledge you need to navigate even the toughest of market conditions. Hello 101 community, welcome back to our YouTube channel. In this video, we will be showing you Warren Buffett's 5 rules for investing in a market crash. But before we begin, if you are new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Now let's start with the video. As the global economy was in the midst of a severe downturn in the autumn of 2008, many investors panicked and sought safety for their money. However, one notable exception was the Oracle of Omaha. Despite the fact that Lehman Brothers, a major investment bank with a significant amount of assets, had filed for bankruptcy protection, and the U.S. stock market had lost a staggering $1.2 trillion in value in a single day, Buffett saw opportunity in the midst of the crisis. In an opinion piece for the New York Times, he stated that he had been buying American stocks, and Berkshire Hathaway made significant investments in companies such as General Electric and Goldman Sachs during this time. While Buffett recognized the gravity of the situation, describing it as an economic Pearl Harbor, he remained confident in the long-term potential of the market and saw the dip as a buying opportunity. So why was he buying stocks that were rapidly falling in price when everyone else was stocking cash under their pillow? Well, when you understand his rules for investment, you would know why he was buying stocks during those hard times. So let's go through some of his rules for investing during the market crash. Rule number 1, be fearful when others are greedy, and be greedy when others are fearful. Warren Buffett's timeless advice for navigating the stock market is to be fearful when others are greedy, and be greedy when others are fearful. This strategy involves making level-headed decisions during times of market panic and taking advantage of opportunities to buy strong companies at discounted prices. Buffett's long-term view is that the value of innovative American businesses will continue to grow, even during economic crises. He advises against investing in highly leveraged or weakly competitive companies, but sees downturns as an opportunity to invest in the future success of sound businesses. Buffett's approach was proven correct in the years following the 2008 financial crisis, as the S&P 500 saw a 130% increase and companies like Apple and Amazon reached trillion-dollar valuations. Buffett acknowledges that timing can be difficult and it may be necessary to appear unimaginative or even foolish in the short term, but maintains that what investors need most is the ability to focus on a few key fundamentals and ignore the influence of market sentiment. Rule number 2, invest in what you know and nothing more. Investing in complex industries or companies can be a recipe for avoidable mistakes. It is important to approach these types of investments with caution, especially if you have little to no direct experience in the industry. As Warren Buffett famously said, never invest in a business you cannot understand. It can be tempting to try and forecast the success of a biotech company's drug pipeline or predict the next major fashion trend, but these types of complex issues are often unforecastable and can materially affect a company's earnings. Instead of getting hung up on trying to understand these types of businesses, it may be better to simply move on to the next opportunity. Peter Lynch also advises to only invest in ideas that can be illustrated with a crayon, emphasizing the importance of simplicity in investing. By focusing on companies and industries that are easy to understand, you can increase your chances of success and avoid unnecessary risk. Rule number 3, never compromise on business quality. While it may be tempting to jump on seemingly good investment opportunities, it is important to be cautious and avoid complicated businesses or industries that you do not fully understand. Warren Buffett has learned this lesson through his own experiences and now focuses on buying high-quality companies with strong growth potential. He has come to realize that cigar butt investments where the initial price looks cheap but the long-term prospects for the business are poor can often be traps that lead to low returns and further erode the value of the initial investment over time. Instead, Buffett advises looking for companies with strong returns on invested capital and economic moats, as these are indicators of a business's quality and ability to compound earnings over time. It is also essential to carefully consider the overall business quality before making any investment decisions, rather than being swayed by attractive dividends or cheap valuations. As investors, it can be tempting to jump at seemingly good opportunities without fully understanding the risks involved. However, investing in complicated businesses or industries that we don't fully grasp can often lead to poor returns and erode the value of our initial investment over time. Buffett's famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price," underscores the importance of focusing on long-term business quality and avoiding mediocre opportunities. By following this advice, we can increase our chances of success in the investing world, especially during a crash. If you like the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. You can also support the channel by visiting our merch shop and buy one of our products. The link is also in the description. Let's continue with the video. Rule number 4, when you buy a stock, plan to hold it forever. When it comes to investing, patience is the key. Warren Buffett famously advises to only consider owning a stock if you're willing to hold on to it for at least 10 years. He has personally held onto some of his investments for decades, recognizing that it can be difficult to find truly exceptional businesses with a bright long-term future. In addition, high-quality businesses tend to earn high returns and increase in value over time. As Buffett himself said, "Time is the friend of a wonderful business." But it's not just about finding the right businesses to invest in. The act of trading stocks too frequently can also be detrimental to your investment returns. Taxes and behavioral biases can lead to ill-timed trades, eating away at your profits. Instead, it's best to carefully consider your investments and adopt a buy right and sit tight mentality. As Buffett put it, the stock market is designed to transfer money from the active to the patient. So if you're not willing to hold on to a stock for the long haul, it may not be worth considering as an investment in the first place. And rule number 5, most news is noise, not news. With a constant barrage of financial news and headlines, it can be overwhelming to try and sift through it all. But as investors, it's crucial to remember that only a small fraction of this information is actually valuable. In fact, we believe the 80-20 rule, which states that 80% of outcomes can be attributed to 20% of the causes, is more like the 99-1 rule when it comes to financial news. That means that 99% of the investment actions we take should be based on just 1% of the financial news we consume. Many financial news headlines and conversations on TV are designed to generate buzz and trigger emotional responses in order to get people to take action. As Warren Buffett said, owners of stocks, however, too often let the capricious and often irrational behavior of their fellow owners cause them to behave irrationally as well. The companies we focus on investing in have proven their resilience over time. Many have been in business for over 100 years and have faced countless challenges, but they are still standing strong. So when news events like disappointing earnings or falling stock prices arise, it's important to ask ourselves whether they truly impact the company's long-term earnings power. If the answer is no, it may be wise to do the opposite of what the market is doing. As Warren Buffett also said, remember that the stock market is manic depressive. In the end, it's crucial to be selective with the news we choose to consume and act on. By focusing on the long term and ignoring the noise, we can make more informed and confident investment decisions. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, don't forget to check the links in the video description. Remember, we live in turbulent times. The global economy is upside down, and we have made it our personal goal to deliver financial education to everyone. Watch more of our videos appearing on the screen right now. See you there.